Hi, welcome to Your Future, Your Finances. I'm Brian Kuhn, and today we have Ken Venick of Equity Mortgage. Ken, thanks for having us on the show.
Thank you for inviting me.
Ken, so you help people with structuring debt of a variety of forms. Talk a little bit about what you do and your background.
Well, I got in the mortgage industry in 1987, and throughout the years we've learned how to help people restructure their debt using the mortgage as a tool and trying to improve their budgets, and also getting them prepared to, if they're looking to buy a home, how to work through some of the debt challenges folks have and get themselves in a position to qualify for a mortgage.
Mm-hmm. And that industry has a lot to do with interest rates. So what's going on with these days with interest rates, and what causes them to go up or down?
Well, right now we're back to pretty much historic lows. As of today, conventional rate is about 3 5/8. At the bottom in 2013, bottomed out about 3 3/8. We're pretty much back at the bottom. The things that affect the rates are, it could be economic signs. Mm-hmm. Typically, if they do not meet expectations, the rates will typically go down. When like the jobs report comes out, mm-hmm. If it beats expectations, rates go up a little bit. If it misses expectations, it typically goes down. So normally, in the mortgage industry, bad news is good news, meaning rates normally improve with bad news. Mm-hmm. Also, geopolitical things that happen around the world could also affect rates. The strength of other countries, if their economies are weakening, the U.S. Mortgage-backed securities and long-term treasuries become a much more valuable asset to obtain, mm-hmm. which helps bring the rates down as well.
Yeah, so it seems like a lot of things can affect interest rates. So let's say someone is looking to purchase or refinance a home. There's interest rates, but there's also credit. There's scores. So how should people be keeping track of their scores and trying to improve them?
There's a lot of tools out there now. There's free sites that'll give you free scores. Unfortunately, they're not the same scores that we can use, but mm-hmm. certainly it's a gauge. So looking at the scale, you can get an idea whether or not your scores are strong or weak. Mm-hmm. But certainly consulting with a mortgage advisor well before you're ready to do something, having them run the credit is another good way to take a look at it. Mm-hmm. Because a lot of times scores can be affected by minor adjustments. Mm-hmm. One of the big ones is balances on credit card debt. You want to try to keep your balances below 50% of the high credit limit. Mm-hmm. So simply by paying down some of your bills, it can drive your scores up quite a bit, and vice versa. If the bills are maxed out, it'll drive your scores down. So we work with trying to help our clients figure out the right balance.
50% of the balance to the limit the card gave you when they issued it.
Or what the current available credit is.
Mm-hmm. Okay. And a big market for the topic we're discussing is first-time home buyers. Mm-hmm. So what are some steps first-time home buyers should be taking to get ready?
Well, once again, we talked about the credit. So if your credit's in good shape, looking at how much money you need for a down payment. I hear a lot of people say, well, I don't have 20% to put down. Mm-hmm. Well, with FHA, you only need 3.5% right now. And in a lot of cases, you can negotiate a contract where the seller will pay all the closing costs. Mm-hmm. So to get into a $200,000 house for about $7,200 to $7,500 is a very attractive opportunity for somebody. Yeah. And the beautiful thing about FHA is they just reduced their mortgage insurance premiums. Mm-hmm. So it's gotten a lot cheaper to get an FHA loan on the payments as well.
Mm-hmm. Okay. So then that's buyers, and then there's people who are looking to refinance. Mm-hmm. Both are a process. It involves a lot of documentation. Is there a list of things that people need to have handy?
Well, the basic items that a lender is going to need are going to be income statements, whether it be if you're employed, W-2s, pay stubs, bank statements to show assets. Mm-hmm. A list of liabilities if you have them. If not, pull them up on the credit report. And then we look at the game plan, mm-hmm. whether it's a purchase or refinance, figuring out affordability and figuring out which is the best program. Mm-hmm. A lot of people that already have a mortgage aren't looking to do a new 30-year. We look at a 20-year or 15-year to shorten their time frame, sometimes not even increasing their payment, and they can reduce the number of years they have on the mortgage paid off a lot quicker.
Okay. And then a moment ago, you were talking about mortgage insurance, they call PMI, I believe. That seemed to be more rare a while ago, but now it's more prevalent. How does that work?
Well, when there was more creative programs and people used to do 80-20s or 80-15s where you put a small down payment and you get a first and a second mortgage. But mortgage insurance has gotten a lot more inexpensive now. So a lot of times it doesn't make sense to do the two loans. You can still do the regular mortgage insurance. And once you hit 20% equity on your mortgage balance, you can request the mortgage company take it off. Now, the one negative change with FHA is the mortgage insurance is permanent. So it's once you do the loan, it's going to be on there for the life of the loan. So you just got to factor in that that's going to be part of your interest rate.
Okay. All right. Makes sense. We're talking with Ken Venick of Equity Mortgage. Again, my name is Brian Kuhn. You're watching Your Future, Your Finances. We have a lot more to cover. We'll be right back. We're going to take a break. Thanks very much.